Well, g'day everybody. Welcome to FX Street. My name's Renshi, or James Weegen, and I'm in Australia. I'm going to do basically a presentation today and lesson on consolidation. And this is this is an extraction out of our advanced lesson 10 on consolidation and the straddle. Whoops. So basically, what consolidation is the market's just sort of in a indecision of which way it really wants to go. People are probably taking a lot of profit, or there's been a really large, fast move, and then it's just gone into consolidation until people can gather their thoughts what they're going to do. The big hedge funds and all that sort of guys are still working out if they're going to continue or try and reverse the market. Now, consolidation is the stretch of time where the market is moving sideways within a range without any sense of direction. It's found on any time frame, can create tight consolidation of 20 to 40 pips, or it can be large range over several hundred pips when you're looking at like the weekly charts and monthly charts. To be considered a reliable consolidation, the market requires a minimum of 5 hours with a tight consolidation during peak trading hours. So, for instance, 12 a.m. New York to 12 p.m. and Sydney time is 4 p.m. to 4 a.m. Now, trading consolidation, several different approaches can be used depending on the width of the consolidation range. Tight consolidation is up to 40 pip range, so the low and the high is got to be under the 40 pips. Mid-size consolidation about 80 pips. And a large consolidation range, when you're looking at probably daily charts, weekly charts, you're looking at 100 pips there. So it just depends on what style of trading you're doing. When the market is in consolidation, it will often break out in the direction of a previous trend. Upon a breakout, if the currency returns inside the initial range, then there's an increased risk of a whiplash taking place and the currency heading back in the opposite direction. The risk rules and workable stops can be a challenge when trading consolidation zones. But remember, only trade if your risk and money management rules are being adhered to. I'll have to give you that EU target in a minute. Oh, hang on. No, I don't. Sorry, I hadn't calculated that one yet, Tom. Sorry, mate. All right, here's a chart here, and you can see the market's really moved down nicely. Some profit taking happened. So people who are obviously up here have come down, start taking profit, and then the market's gone sideways. So there's no sense of direction now. A lot of the times it'll just continue back into the trend, so this could be coming back down again. But we need to have it for a period of 5 hours in a tight range. So if this is a 30-minute chart, we've got 1, 2, 3, 4.5 hours here. If this is an hourly chart, well, we obviously got more than 5 hours. This is the GBP USD 60-minute chart, so easily in that range at the moment. So we need to work out a few things. We need to know that this market is clearly in a downtrend. We've hit a 618 extension on the pullback. So this is the 618 extension here. You're using your fibs from the top to the bottom. It's pulled back at a 382 and a 382 bounce, usually looking for a 618 extension. This is what it's done, gone just past it and pulled back. So now we're just holding below the new level of the 382. So now we re-look at where we are, and we just draw the lines at the top and bottom of the consolidation. So the high in this case is 74.53, the low is 74.30, so we've got a 23 pip consolidation. Now what we need to do is find out where we're going to have our entries and stops on either side of when the market breaks out. So to the higher side, you can have 15 to 17 pips as an entry to the high side and 10 to 12 on the low side. Now, the reason why we have more on the high side than the low side is because when you're getting into the market long, you've got the spread as an extra going long, so you've got to take that spread into account. So it's 10 pips plus your spread, or to just make it easier, 15 pips to 17 pips. On the short side, we've already paid for the spread on the short side. It means we've just got to go a few pips past to get paid on that one. So this getting 12 pips entry on the short side is where you would place your entry on the short side. However, there's a 52 pip range between these two. So if you were going short at 74.18, your stop would be up at 74.70. 52 pips. Then you got to look at your account and say, can I afford that? Is that really affordable in my trading account? So if not, you might have to pass on the trade, or the other side you could do is lower your exposure. In other words, if you're trading one full lot normally, to get back inside your risk rules, you might have to do half a lot, 5 mini lots, and that still will let you be able to put yourself in the trade, but not go over your money management risk rules. Tight consolidation provides the opportunity to set up a trade where you can. Again, I've just covered this one, 17 pips above, 12 pips below. Now, when the market breaks the consolidation, it will trigger the trade with proper stop location as soon as the entry stop is reached. Here we are here. We've broken out of the consolidation. Entry was at 74.18, and we're down. Now, if we're only going for 30 pips, and the market moves in 30 to 60 pip moves on average, then you can lock in your 30 pips there. Now, with mid-range consolidations, they are limited to your risk rules, but are only two options that are considered for such trade, such ranges. First option, trade the consolidation on stop option. Crystal, it's the short sell territory. In other words, on the short side under a trend line. And LST is the long-term territory as well. Sorry guys, I've just got to remember to come back to this other screen to answer any questions, but feel free to ask as many as you like. Now, the option 2 is to let the market break out and wait for a pullback to take an entry. Remember, this is in mid-size, so you're looking at 80 pips. So here we are with a larger one. We've got the high at 7,444, the low at 7,400. That gives us a 44 pip range. Again, mark your entries and your stops above and below, 12 pips below, 17 pips above. In this case, it's 73 pips, which is pretty big. The largest I'll ever have a stop is 50 pips. I don't think a trade is worth any more than that. So I would probably pass on this. I might more than likely wait for a breakout and then a retest. A lot of the times it'll come back and retest the high of the consolidation and give me an entry to go long then. Boyke, there's because of your spread. Okay, going long, you've got to add your spread in, so it's 10 pips plus the spread. And I normally look at 15 to 17 pips because some people have got large spreads, other people have got smaller spreads. So around about, I would make it the minimum of 15 because it will spike up and just retest and push down. And on the low side, you're already paying your spread, so you've got to go just past that 12 to get out of the trade. You know what I mean? So if you've got a 3 pip spread and you've got your target there, it's got to go 3 or 4 pips past to get you out of that level. Now, 73 pips is a very big stop when you're just doing day trading. So on a larger ranges, you could make the middle of the consolidation your stop there. It is a higher risk, but it still lowers your money management risk. Now, if the market retraces all the way past the center of consolidation after the breakout, there's a strong potential for the market to reverse and head in the opposite direction. Placing a stop in the center limits the risk involved while providing the opportunity to take a trade which under most circumstances would not meet your risk rules. Carried by having your stops above and below the consolidation. 15 pips to 17 pips above the consolidation and 12 pips below. No, you're only entering one unless, well, with this mid-sized consolidation where it's a larger one, which you're probably trading a 60-minute or a 4-hour chart in consolidation, then if you've got your stop in the middle and it comes in, say it broke out long, comes back and stops you out, there's a good chance that it's probably going to continue short. So you're out at a nice level here. You wait for the breakout on this side to enter. So whiplashes will do that to you. Normally, if it does a false breakout, it'll come back through, and it's usually a nice violent run to the other side. So you can then get out at a manageable level, still re-enter, make up that loss, and get some profit on the short side. In general. So this is the warning. This type of trade involves more risk since the stop loss is not located above or below the levels of support and resistance. So we are here. We'll be in the trade at 73.88. You brought your stop at 74.22. This is the mid-range. This is a large consolidation. The smaller ones, you don't do this. But this allows that if the market comes back up, you've got a reasonable stop. So this is still mid-range consolidation. So again, we do the same as the smaller consolidation. We mark out the high and low of the boundary. We know this is a 46 pip range from the high to the low. Now, the option 2 plan is start by making boundaries of the consolidation, as with tight consolidation, wait for the market to break out and close outside the consolidation range. So, if this closed 30 pips above, and it's above the range, then you could look at entering and have your stop either at the top of the consolidation or halfway through. That's the option 2. Option 1 is obviously when it have an entry order at 17 pips above and enter automatically there. So it's up to you which way you go. So again, we start making the boundaries on option 2. Wait for the market to break outside the consolidation range. And you can see how it's come back and tested. And you can also enter back on there as well. But that's pretty risky, that particular one. So for wider ranges of 60 pips plus, the stop loss can be placed at the center of the range. But this increases the risk of losing a trade due to a deeper retracement, similar in option plan 1. I like to usually use just the 17 pip. I don't do mid-range consolidation. I like to do the tight range. So here is a nice breakout here. This is a mid-range one where the markets come back to consolidation. And a lot of times it will come back and test. You can have your entry around here. Probably one of the things that, because it doesn't penetrate through, you might even have just a 5 pip buffer. So 5 pips above the 88.96 to make sure you get kicked in before it goes up. So the trend was up and it just continued that way in this particular case. Now with wide range consolidation, and you're looking at anything up above 60-minute charts, I more look at wide range consolidation from the 4-hour charts up. We do the same thing. We find the high and low. Now, as the market approaches the boundaries, look for candle formations that signal a bounce and reversal. trading according to your candle formation rules. So this consolidation is really big. You can then start to look for bear candle formations and trade down to the support. Now, if you've got multiple lots on, it's a good idea. Say this was about 80 pips, and you're getting in 20 pips from the high. You could trade this down for 30 pips, take some of your position off, bank it, bring your stop to break even, and if it keeps going, great. And the runner will just keep going. If the runner comes back to break even, well, you've already banked some profit. Here we are. Here with just the diagrams for your candle bullish and bearish candlestick formations. You can either have a lot of tails coming through, engulfing candles, whatever the formations are on candlesticks that you're used to using. Okay, let's have a look at a live chart. I'll just bring that up. My GJ actually hit the target that we'd put in the room, 145.91. It's gone to 146, so that's good. Secondary target will be 147.13. And let me just have a look at the GU. Didn't quite make its target, 61.95. 61.76 is the central pivot line. The last chart. Yep, hang on a second. What were you wanting to know there, Boyke? Did you have a question there? Okay. All right, let me grab a chart that I've pulled out from before. All right. Here's I've just circled some consolidation here. Now this is a 30-minute chart. So let's have a look at what we've got here. This is 8:30 in the morning, so we're coming up into the Asian session. So the high is 5999. So we mark that. And I'll make that font a bit bigger. There we go. Put a line on the top of that, right there. Put a line at the bottom of the consolidation. And then once it had the true push out, that 17 pip buffer that we've had here, we didn't get in falsely in this area. It kept us out of it. And then once it went through, okay, so let's see how far it actually went up. Where's my trusty little calculator again? It went 6067. We entered at 6024. Gave us a 43 pip run up there. So if you're going for a 30 pip run, easily got your 30 pips. And here we are. You can also see that this happened to be a false breakout. It punched down into the middle of the consolidation. Now, the easiest way, well, two ways to find the middle of the consolidation, obviously, is just halve the difference here. Or you can just cheat a little bit, grab a fib tool, take it from the bottom of the consolidation to the top. And what I do here is put in my 50 and take everything else off. Especially for wider consolidations, it's nice to have that little tool there. And there was one I missed. Where was that one? Over here. And that's your 50% line. So look how it came back. Just say this one did not come up to a profit came back. That's why we have on the larger ranges. That's why we have the 50% there as the stop. It just come just down past it. So it's still a nice logical area to place it. Now with the violent reaction back, so the false breakout pushed back down, you're now in at 5985 down here. It did come up and play around here. But you can see with this particular consolidation, it was really violent reaction back. So if you didn't get profit here, yeah, you would have been stopped out twice. That's part of the just managing your trade. And if you manage your trade right and keep your runners going, or keep you're going to then always be in front. So that's basically how simple it is with consolidation. Just measure the high, measure the low. Now there is one other thing you can do. Let me just find another consolidation to show you. Should be able to do it on the other one when we get back to it. Yep, we'll be able to do that. With let me just get rid of all these. When you've got a nice true consolidation, if you measure the low to the high, all right, and I'll just use my little measuring tool here. We go from the high to the low, and you know when you've got consolidation, you can do this beforehand. That says 72 pips, all right? So if I measure 72 pips from the low, let's see if that gives us a good target area. Yep, look at that, nearly to the pip. So when you have consolidation breakouts, measure from the high, that's the extreme high here. Doesn't have to be the high of the consolidation where you're measuring, just the highest candle. Take it back to a decent low that you've got beforehand. That will tell you the measurement of strength. This is like pulling back on a bow and arrow. This is the archer pulling back the strength. This measurement here gives you a fair idea how much strength there is when there's a breakout. So if you're on the right side of the breakout, you can basically say, okay, well, that's my target area. Now, if it gets within 10 pips of that target and starts to pull back, then you can bring your stop up. You can bring it up from your break even to protect, say, well, that was, say about 40 pips. You can protect 20. So you're not making a winner go into a loser. Has everybody got that? Because equally, when you get the reverse, okay, so if we go from the high now, when we realize this is a whipsaw, and we come down 72, so you can see up in the top left there's the range there. There's 72. And as I said before, with whipsaws out of consolidation, it normally will double the other way. If it doesn't go far up, you can come back. So this should come down around about 140. Let's have a look at it. There you go. So you can make up your loss if you made a loss on that and still come back through. This is around about 80% of the time with whipsaws like this that'll work. So if you just do some back testing on the weekend and have a look at that and practice that measurement, you're going to find it's pretty good. Okay, has anybody got any questions on any of that? All good? Great. Okay, let me just go back to my normal charts. And I'll just explain how we work the trades today. And I'll just bring up my daughter's account so you can see what I've done there. So I've just got an education fund for my daughter and just using Forex to pay for it. Okay, so I did one full lot earlier in the session. It started to it went up about 20 pips, started to come back, so I just put my stop up to +4, +5 I think it was, just in case it just kept coming through because it was earlier in the day, and just grabbed $50 on that, no problems. Once it had started, I reassessed and I thought, okay, it's really got the momentum going. I was then I re-entered again, but not at such a nice level. Earlier was 145.14, got in at 34, took most of my position off at 23. So out of the one full lot here, I took 8 mini lots at 23, and I let the runner go. But unfortunately, I put my stop a little bit too close. It came back and stopped out at 1.2, rather than continuing on to the target of 145.91. Now, this was the reasoning why. Let me bring up my daily. This is the reasoning why I was looking for a long for the short term, is that the markets has done a run up. We had a lot of consolidation range here, pushed back down, and we had 1, 2, 3, 4, 5 days of trying to get through the monthly pivot line of 144.63. So that's a lot of support there, and even the spike down, we still couldn't close below it. And this aqua line here is showing on my 30-minute chart where the monthly central pivot line is from the month before, and it couldn't get through that either. So this was my thinking, and then pushing back up towards another daily support resistance line that I have on the daily chart, on the 30-minute chart. So I bring my 30-minute chart back up. Oops, sorry, wrong currency. There we go. Now on the 30-minute chart, looking at what I was just looking at on the daily chart where there's a lot of support, I could see also before I started trading, and I opened my charts up when the charts were around about here, I could see that there was also already a lot of support building. This came down, basically retested this level here, and if you're with in the presentation I did last week, we're talking about support and resistance and how you can use them to the effect. So once I'd seen this and had confirmation with my double histogram here, see how I've got the black and yellow above? That was my confirmation to go long. 145.24, I got in on the pullback at that 14, as you saw before. And then my target was at 145.91, but got stopped out before that. But that's no problems. So again, support and resistance played a big part. There's 3 of them there. The more time, 3 is a charm, the more times it comes down, the better it's going to be for you to start looking to head off. The other chart that had a beautiful example of that today was also the GU. Look at all this support here. Once, twice, 3 times, and I'll just scrunch this chart up a bit. You can also see, starting with my Fibonacci from here up to the top, it's come back to an 86%. 3 times on the 86%, couldn't get below it. This area over here is also reflecting the same levels of support. And this was what we had in the room. I said to my guys in the trading room, anybody wants to do an aggressive trade when the market was down here, have you stopped just below the 61.12, I think it was. Yep, 61.12. And just scalp up to the EMA. And that's what they would, a few of them grabbed 24 pips on that. Now, what have we got here? We've got support being met at 61.76. We've got a nice evening star here, decision candle up, small indecision candle, Nice big candle coming back. That's more than 60% of this body here. So now we're starting to look like that the bears are starting to take some more control back off the bulls. It hasn't confirmed at this stage if we can keep continuing to go down, but at the moment we're back into this congestion here. So we'll have to just wait and see what's going to happen. I'll just go to the daily chart on the GU. Whoops. Where's my daily? There it is. And you can see here on the GU, there's my 34 EMA right here. I've got some nice long tails on these dailies rising. We grabbed some pips going up on this one yesterday. Now we've come back on yesterday's candle, nice long big rejection candle, which is basically retesting the highs of these candles here. Pushed back down and closed under the 34 EMA. So we are looking at that we could have a resumption to the short side, but we need to take out these bottom tails first. This is a 618 Fibonacci, so you can see the tail has just come short of that 618. But if we do continue to come down, we could be looking around about the 786 at 59, 64, but we don't have confirmation of that yet. So at the moment, this GU is just a little on the confused side. If you pull the charts back, the confusion is shown a bit more. We've got a head and shoulders pattern up here. The head and shoulders pattern has been retested right here, but it hasn't been able to complete the whole cycle. It completed the cycle for the head and shoulders partially, but then we started to have a bull head and shoulders. All right, so there's the left shoulder, the head, the right shoulder. It started to push up, but again, it's having trouble at the base of this head and shoulders. So this market at the moment is pretty up and down. Nothing, it's just directionless. We just need to wait for one of these head and shoulders to actually dominate and push through. Hey Greg, which double move was that for the consolidation one? Or was that on the one of these, the GJ or the GU chart? The guideline is measure the high, find the figure for the high and low of your consolidation. Say it's 6,050 to 6,020, and then have your auto entry order 17 pips above, and on the low 10 pips below, 12 pips below. And then you use the other side as your stop, provided it's under 40 pips. The consolidation's under 40. If the consolidation is 60 plus, then you look at use the middle of the consolidation, the 50% part of it, as your stop, because your money management rules will usually be right out the window. And the only way you can look at your money management rules is by lowering the amount of lots that you're trading. So if you've got, let me just bring that up again. Here we are here. So you've got a $10,000 account and you're risking 2%. That means you can only risk, to stay inside your money management rules, you can only risk $200 at a time, or over how many trades you've got, or over one trade. If the stop is 30 pips, well then you can trade 6 mini lots. If the stop's only 20 pips, well you can trade one full lot to stay in that 2% range. However, if the stop is 60 pips, you can only trade a maximum of 3 mini lots. Oh, you're talking about the whipsaw. Yep. So again, you just need to measure the. I know what you're talking about now. Let me go back to that. Sorry about that. I'm a little bit thick today. find that chart. There we are. So if you find the last decent low that sticks out by itself, this low here doesn't stick out by itself. This one here does. So you take the last previous high and the last previous low, and you figure out how many pips that is. Then going from the low of the consolidation, so in this case it was 72 pips, from the low of the consolidation you measure 72 pips up, and that can be a logical target. No problems, Greg. All right, so that's how you can measure the strength. This is like the markets here. If you work out consistent ways to find out how to measure the strength of a market, it's like knowing how much fuel you've got in your fuel tank and how far you can drive on it. And if you put your foot flat down, well, obviously you're going to use up more fuel. So then if you want to be a bit more economical, you drive with less on the pedal. And that's what I mean by your money management. You need to, if the stock's too big, well, take your foot off the accelerator, have less lots, less exposure, but you can still be in there to try and make some pips. They can, and it just depends on how often, I don't know. But as long as you're sort of prepared for it and understand it. See, the whole thing about with trading is if you have a loss, don't worry about it so much. If your system is nice and secure, then it's how you manage that loss. What are you going to do on the next one? You don't want to go into revenge trading where you start to double up and say, right, this bloody market, blah, 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 blah. I'm going to I just had one lot on there. I'm going to go the opposite direction. I'm going to have 5 lots. That is just a sure emotional way to lose your account. But if you have a formula that you can say, right, this whipsaw has just happened on a false breakout of the consolidation. Well, okay, I'll do this measurement, and if this happens, I'm going to do this, and you have a set plan. And that set plan will, be good. If it double whipsaws, well, okay, it's just 2 losses you've got to wear. And then, the next trade. So if you lose 30 pips on one, you're hoping to make 60 pips on the other with the same size money management. Then obviously you're going to make up the loss and make profit. Yeah, exactly, Tom. All we're doing is just finding out how much fuel is in the rocket to how far we can drive it. So let's just do a consolidation wrap up. Consolidation is a lack of trading direction which is has conflicting bull and bear signals going nowhere. Trading inside tight consolidation is considered aggressive, but be patient and look for the breakout signal to trade in that direction. Now, a little tip: use your alarm tool on your charts or your ordering software once consolidation is formed to alert you when the breakout is happening, because you might be looking at another chart and you'll miss it if you're trying to do it manually. So just put your price alarms, say 5 pips before it hits the actual consolidation line that you put in. That way you don't have to watch them and you can go look at other charts and look for other entries and other charts there. So just like to thank you guys for listening to us again. I'm Renshi. My name's James. I'm from pipsandtips.com. Come and join us. We have an EAL program, Earn As You Learn. So while you're learning to trade with us, we call trades in the room. We give you the targets, so you're earning while you're learning as well. Here's our contact details: Renshi@pipsandtips.com or Renshi4x@hotmail.com. That's my mobile number, and that's our web address if you'd like to come along and trial us. If you've got any questions, please feel free to email us. But yeah, We have a lot of fun. We've got a nice small group that trades with us, and yeah, we grab some nice pips as well. Thank you very much again, guys, and we'll see you another time. By the way, guys, if there is a topic that you'd like me to cover, whether it's like today, consolidation, send us an email. Tell me what you're looking for, what you're wanting to learn, and I'll cover that. We'll cover them, the ones that are asked the most, in the future sessions. Yeah, good to see you, Greg. All right, guys. Thank you very much.